Tesla has been one of the most exciting and polarizing companies in the world. From revolutionizing the electric vehicle industry to ambitious ventures like autonomous driving and energy solutions, Tesla and its CEO Elon Musk have created a global phenomenon. But with great ambition comes great risk. Could Tesla's meteoric rise be followed by a steep fall? In this video, we'll take a deep dive into why Tesla stock might face significant challenges in the near future. We'll look at its current performance, concerns raised by major analysts like JPMorgan, the growing dominance of China's EV market, the impact of policy changes under the Trump administration, and some crucial technical data you need to know. Let's break it all down. Tesla's current position, a high valuation story. 2024 was a pivotal year for Tesla. The launch of its Robotaxi product line, designed to lead the autonomous vehicle revolution, generated immense hype. Investors see robotaxis as a game changer, potentially opening a multi-billion-dollar market and transforming Tesla from an automaker into a tech-driven mobility provider. Adding to the optimism was Elon Musk's prominent role in the 2024 US presidential campaign. Musk openly supported Donald Trump and was later appointed as the head of Trump's Department of Government Efficiency Commission, or DOGE. This alignment was seen as a strategic move to influence policies favorable to Tesla. Despite these developments, Tesla's financial metrics are showing early signs of stress. Operational cash flow, one of the most critical indicators of a company's financial health, fell by over $2 billion in 2024 compared to the previous year. Tesla's ability to generate consistent cash flow is being questioned, particularly as the company embarks on capital-intensive projects like robotaxis and gigafactory expansions. Moreover, Tesla's price-to-earnings (PE) ratio currently stands above 60, making it one of the most expensive stocks in the automotive and tech sectors. For context, traditional automakers like Ford and General Motors have PE ratios in the single digits, while even high-growth companies in the tech sector hover around 20 to 30. This high valuation assumes near-flawless execution from Tesla in the years ahead, a risky assumption given the challenges it faces. JPMorgan's dire warning for 2025. Adding fuel to the fire, JPMorgan has issued a warning that Tesla's profits could decline by as much as 40% in 2025. The report highlights several factors, including declining sales, regulatory risks, and increased competition. One immediate concern is the potential removal of EV tax credits under the Trump administration. These credits have been instrumental in incentivizing EV purchases, particularly in the US, Tesla's largest market. Without them, Tesla's vehicles become significantly less affordable compared to both traditional and electric competitors. Further compounding the issue, Tesla reported its first annual drop in vehicle sales in over a decade in 2024. This decline was modest, at around 3% year over year, but it marks a worrying trend for a company that needs consistent growth to justify its valuation. The robotaxi gamble. High risk, high reward. Tesla's future is heavily tied to its robotaxi initiative. If successful, this could revolutionize transportation, create a massive new revenue stream, and potentially double Tesla's market cap. However, the challenges here are immense. For starters, regulatory approval for fully autonomous vehicles remains elusive. Governments and regulators across the globe are taking a cautious approach to autonomous driving technology, given safety and liability concerns. Then there's the competition. Tesla isn't the only player in the robotaxi race. Companies like Waymo, backed by Alphabet, and Cruise, owned by GM, are already conducting pilot programs in multiple cities and are seen as having more advanced autonomous technology than Tesla. From a financial perspective, developing and deploying robotaxis is capital-intensive. Tesla's capital expenditures reached nearly $9 billion in 2024, a 30% increase from the prior year, with much of this spending directed toward autonomous vehicle technology and gigafactory expansions. While this spending is necessary for growth, it puts additional pressure on Tesla's already strained cash flow. China, the rising storm. China is the largest EV market in the world and a critical piece of Tesla's growth story. Tesla's gigafactory Shanghai accounts for a significant portion of its global production and revenue. However, the Chinese EV market is becoming increasingly competitive. Local companies like BYD, NIO, and XPeng are rapidly gaining market share. In fact, BYD recently overtook Tesla as the world's largest EV maker in terms of volume. These companies not only offer high-quality vehicles, but are also undercutting Tesla on price, thanks in part to generous government subsidies and lower manufacturing costs. Adding to Tesla's challenges in China are geopolitical tensions. Any escalation in US-China relations could disrupt Tesla's supply chains or even result in tariffs or restrictions on its operations. Valuation concerns and investor sentiment. One of the biggest criticisms of Tesla is its valuation. As mentioned earlier, its PE ratio of over 60 far exceeds that of its peers. This means that Tesla needs to deliver extraordinary growth to justify its stock price. However, JPMorgan analyst Ryan Brinkman has raised doubts about this. He stated, "Tesla does not appear to us on track to dominate the global auto industry amidst the electrification transition." Tesla's free cash flow margin has also dropped to 4%, down from 8% in 2023. This decline reflects the company's heavy spending and increasing operational costs. As margins shrink, the risk of a valuation correction becomes more pronounced. Investor sentiment is also becoming more cautious. Short interest in Tesla stock has risen to 3% of total shares outstanding, reflecting growing skepticism among market participants. While this is still relatively low, it marks an increase from previous years when Tesla was seen as an untouchable growth story. Competition is heating up. Tesla's first-mover advantage in the EV space is shrinking. Traditional automakers like Ford, GM, and Volkswagen are now fully committed to electrification. These companies have the resources, experience, and scale to compete aggressively. Moreover, startups like Rivian and Lucid Motors are targeting specific niches, such as luxury electric SUVs and sedans. As competition intensifies, Tesla will need to invest heavily in innovation and marketing to maintain its edge. What does this mean for investors? For investors, Tesla presents a classic risk-reward dilemma. On one hand, the company has a proven track record of innovation and could still dominate the EV and autonomous driving markets. On the other hand, its high valuation, declining margins, and mounting challenges make it a risky bet. If you're an aggressive investor who believes in Elon Musk's vision, Tesla might still be worth holding or even adding to your portfolio. But if you're more conservative, it may be time to consider diversifying into other EV players or even traditional automakers making strong moves into electrification. Final thoughts. Tesla's story is far from over, but the road ahead looks challenging. Declining sales, competition in China, regulatory hurdles, and a sky-high valuation are just some of the risks investors must consider. What do you think? Is Tesla headed for a correction, or will it continue to defy the odds? Share your thoughts in the comments below. Don't forget to like this video, subscribe for more insights, and hit the bell icon to stay updated. Thanks for watching, and I'll see you in the next one.